Good morning or good afternoon, depending on where you are in Australia, and thank you for joining this webinar with RSM and Colin Biggers Paisley on business exit strategy. Today will be the final webinar in our three-part series, where the topic of exiting via an IPO will be covered by Tim Goodman from RSM and Brent Van Staden from Colin Biggers Paisley. Our previous two webinars also addressed areas including getting ready for sale and exiting via trade sale. If you missed any of the webinars in this series, we will be providing all resources and recordings of these sessions to you by the end of the week. If you have any questions throughout this webinar, we will have time at the Q&A session at the end, so please put your questions in the Q&A box on Zoom. All questions we receive will be posed anonymously to our panelists to answer with the wider group. This slide here is to advise you that the information covered is intended as general information only and shouldn't be considered advice. Should you have any queries post this session and would like to discuss any areas in more detail, please feel free to reach out to our presenters directly to discuss your needs. I would like to introduce the speakers for the series, RSM's Andy Graham and Tim Goodman, and Colin Biggers Paisley's John Meadmore, Toby Norgate, and Brent Van Staden. Today, Tim Goodman and Brent Van Staden will take us through the business exit strategy of exiting via an IPO. I will now hand over to Tim Goodman to take us through what we will cover today.
Thanks for that kind introduction, Galena. Today we'll be discussing an exit via an IPO route. And discussing some of the quantitative and qualitative elements of what that process encompasses, as well as the accounting and legal regime surrounding that. So firstly, we'll talk about, is a listing right for your business? And we'll go through 5 largely qualitative elements that you need to assess as vendors and whether an IPO is right for you, what a typical IPO process and timeline looks like, what you should know before you start, key reasons for an IPO. We'll talk through 9 typical rationales for why companies IPO on the ASX, what it means to become a public company, how you do that, as well as looking at some of the ASX listing requirements, and then importantly dealing with the ASX as well as ASIC as part of that process. Now, before we start the webinar, we'd just like to take a straw poll of the audience, and we won't be publicly disclosing the results, but really keen to understand, are you considering an IPO? Okay, thank you everyone for voting. The results are in, and it's great to see that there's an abundance of people on the webinar who are actually quite keen in terms of an IPO process and considering that. So it's a delight to sort of talk you through, what that means today if you haven't been through that before. And I think firstly, what can an IPO offer you, particularly an IPO on the ASX, and you can distill that largely down into 9 key areas. And firstly, and probably foremost, it's access to growth capital. So most people seeking a listing, are largely looking to either raise money for growth, to pursue their longer term strategy, or a liquidity event, or a combination of both. So clearly an ASX listing it through an IPO achieves that for you. Now, an IPO also allows you to use your shares as currency for future growth. So what that essentially means is, if you want to undertake acquisitions, you can use your script as currency or as purchase consideration, as opposed to using debt or surplus cash. It gives you an ASX listing, gives you a higher public and investor profile. So once you become listed, there'll be typically analyst coverage of your stock. There'll be media awareness by virtue of you being in the public domain, as well as your industry. You might be the only listed person in that sector. So by virtue of that, you'll get awareness, and that will help drive, hopefully, demand for your shares. What everyone hopes for is a good level of institutional investment. And what that essentially means is, increased credibility. If you've got a good insto investing in your company on the register, that allows a greater access to capital and consequently an enhanced level of liquidity. Clearly, a listing gives you an improved valuation and draws a marker in the sand for what your value is really worth once you're publicly listed. Once you become listed, you've got ongoing reporting requirements as well as much more rigorous disclosure. So what that creates is a much leaner and more efficient process internally to ensure you meet those requirements once you become listed. A listing also provides a secondary market for your shares. And what that essentially allows is people to invest in your company. If there's value accretion, they sell and make money. So that drives not only demand for your shares, but also liquidity and allows you to better access capital. A listing allows you to align the company's strategy with your employees' aspirations. So through such things as an employee share scheme or performance shares or options, you can align your employees' interests with the longer term organisational strategy or goals, and hopefully create value of which your employees are rewarded for that. It's also a reassurance to both your customers and your suppliers in terms of your credibility and reputation. Obviously, once you become listed, you're in the public domain, there's typically an improvement in your reputation, and that allows you as a business to pitch for contractors and tenders, which previously you may not have been able to because you couldn't demonstrate that reputation or credibility. What people should consider before they embark on a listing process is the listing right for your business? And there's 5 key questions I'd like to ask the audience that you consider before you embark on that process. Obviously, once you become listed, there's an increased level of reporting requirements from regulation, not as a consequence of both the ASX and ASIC, as well as more broader market regulatory requirements as well. So once you become listed, you've got continuous disclosure protocols. Some of those relate to half-yearly and annual reporting, but also anything material that affects your business, you need to announce that to the market. So there's a greater level of administrative burden as a consequence of that. And obviously that brings with it an enhanced cost structure by virtue of you may need a company secretary to assist with that process, or at a minimum, a chief financial officer who has had listed company experience that they can help you navigate and migrate through that process. So there's a cost element attached to that, as well as an increased administrative requirement. Privacy is one thing that affects all public companies. Once you become public, in the true sense of your word, everything is disclosed in the market and in the public domain. Obviously, things such as directors' interests or related party transactions all need to be disclosed to the market. Your strategy becomes everyone becomes aware of your strategy going forward, so you can lose some of that potential competitive advantage that you might have had as a private company, and you're obviously subject to a higher level of scrutiny as a consequence of that. You've obviously got increased public oversight. So a lot of the times, operating a private company is very different to operating a public company. And as a private company, you can do as you see fit. It's your business. But once you become public, you've got an obligation to the public company shareholders to operate your business in accordance with the Corporations Act, as well as the ASX requirements. So typically you can no longer do a lot of the things you did previously. So that can be quite a culture shock for a lot of vendors. So you just need to be sure that you can continue to ensure that you meet those requirements going forward as a public company. With a listing obviously comes cost, as well as complexity. So typically you need to appoint advisors as part of an IPO process, such as lawyers and accountants, as well as a lead manager, as well as a board. You'll need a couple of non-executive directors who have got previous ASX listed experience, and all that comes with a cost. So you need to be very sure of what the initial listing costs, as well as the cost post-listing in terms of how that affects your cost structure, and make sure you're aware of the impact of that. And time is also very, very important. Typically, you're looking at a process which, at a minimum, you should be allowing 6 months, but can take up to 2 years, depending upon the size and complexity of your business and what you need to do to ensure you're compliant initially with the listing rules, but compliant as a company in the aftermarket. And that's really, really important around things such as governance, making sure you've got the right management team to operate the business as a listed company. I'm not going to dwell too much on the IPO process and timelines, as Brent's going to discuss that as part of his presentation, but you can typically distill an IPO process into 7 steps. Firstly, it's appointing advisors. Secondly, it's preparing the prospectus and due diligence, which you should allow at least 2 months for. Step 3 is commencing institutional marketing to make sure you've got the right people on your register to benefit liquidity and price. Fourth is lodging your prospectus with ASIC. That's typically a 7-day process for that exposure period. Step 5, and that's typically concurrent with lodging a prospectus, is you'd lodge your listing application with the ASX. Step 6 is marketing and the offer period, and then hopefully step 7 is closing the offer and becoming a listed company. Some of the listing requirements that you should consider, and Brent's going to cover some of these as part of his presentation, particularly structure and some of the legal ramifications. But the ASX is very supportive of both early stage as well as mature profitable companies. And as a consequence of that, there's 2 distinct tests that you can list under in terms of the ASX and meeting some of the admission criteria under chapters 1 and 2 of the listing rules. And really what the ASX is seeking to achieve is ensuring that they've got businesses of a reasonable quality and will be good corporate citizens and be good companies on the ASX going forward. But typically, as a minimum, you need to have the right structure. You need to be of a certain size. You need a certain level of free float and a specific number of minimum shareholders. So the minimum number of shareholders required from an ASX perspective is you need at least 300 non-affiliated shareholders. So that means shareholders who are not related to the vendors or any of their related parties, and that marketable parcel needs to be at least $2,000. You need a free float of at least 20%. Interestingly, the ASX is 25%. But what that means is at least 25% of your shares need to be listed on the ASX, and essentially that's to ensure that there's liquidity in the aftermarket. Now, the two tests I touched on before were the profits test or the asset test. So depending upon your operating history, if you're a mature company with profits, you can list under the profits test. So what that essentially means is you need an aggregated profit before tax of at least $1 million over the last 3 years. And then just before your listing date is confirmed, you'll need to ensure you've got at least $500,000 of operating profit before tax to ensure you meet that requirement. Now, under the assets test, you've got two limbs you can meet. One is you either need a minimum net tangible assets of $4 million, so that's after your offer proceeds and less your offer costs, or a market capitalization of $15 million. And probably the biggest distinction between those 2 tests are the ability to sell down and the escrow period. So under the profits test, the ASX will allow a certain level of sell down to occur. There will be some mandatory amount need to be withheld. You couldn't sell down your entire shareholding, and that's really about managing the value post IPO. In relation to the assets test, there will always be escrow. There's no sell down allowed, and that escrow will be driven by what's called the cash formula. So how that works very simplistically is the lower the buy-in value compared to your offer price, essentially the greater the escrow period. In terms of some of the other broader listing requirements, in terms of spread, you don't need to have your spread before the IPO. The ASX will interrogate very closely the spread just before the listing. So they'll go through the register and make sure that you've got sufficient spread to meet their purposes. And the ASX do dwell on this in a fair bit of detail, and it's one of those key sticking points we see on a lot of IPOs where there potentially may not be the appropriate level of spread. So a good example is, if you've got two shareholders with the same address, you can only count one of those shareholders for your spread. So very, very important. And we have seen before, the ASX clamp down on spread and people manipulating spread, and there's obviously ramifications for that. The last point I want to touch on is around the assets test. And again, one other important element attached to that is you need a certain level of working capital. And that's really to ensure that you meet your prospectus's objectives as they are stated in the prospectus, so that the directors will need to sign off that there is a certain level of working capital to be able to meet those objectives. There's no working capital requirement under the profits test by virtue of the company being profitable, so working capital shouldn't be an issue. But under the assets test, you need a minimum of $1.5 million of working capital. And the ASX will test that quite rigorously when they look at your source and use of funds. So what they don't like is too much working capital, because they don't want a cash box post float, but they don't want a business where there's insufficient working capital, because the last thing they want you to do is have to raise money, do a secondary raising very shortly after an IPO. Very, very quickly, some ongoing obligations that you'll need to do from a reporting perspective as a listed company is you'll need to report twice yearly. There's a half-year review required, and then there's an annual audit required as well. And there's very prescriptive timings around when you need to report to both the ASX and ASIC in relation to those reporting obligations. Typically, if you're listing under the assets test, you'll also need to lodge a quarterly cash flow, which is called a 4C. And really what that attempts to do is true up your source and use of funds from the IPO, and then how you're using those in reality as a listed company. So there's a fair bit of continuous disclosure required from a financial reporting perspective under the assets test. Obviously, with a profits test, you just report twice yearly, as I noted before. But thank you for listening, and I'm going to hand over now to Brent Van Staden to discuss his part of the webinar and talk about some of the legal aspects.
Thanks, Tim. I've had the pleasure of working with Tim on several IPO transactions. I'm very enthusiastic about talking to you today about our experience with IPOs from the legal perspective. I'll still quickly get my slides going, of course. Give me one sec. Hang on, here we go. There we go. Right, yeah. So back on track. So I've worked with Tim on a few transactions, and I'm grateful for the opportunity to talk to you, especially since the initial poll indicates that many of you are actually interested in potentially looking at a listing. So in terms of what I'll cover today, on the basis that the IPO procedure is a way of channeling a whole lot of information through a regulatory filter to achieve a result that gives you compliance with the rules and obviously a listing on the exchange. So what we'll cover in particular is the IPO team. So who's involved in the IPO? Some of the issues that Tim touched on, pre-IPO structuring of your company. The ASX admission requirements, some of which Tim has touched on already. The prospectus, which is one of the key documents that we produce during this process, just a bit about what needs to go into it, how it gets produced. Due diligence in terms of what the process entails and why we do it. It's certainly one of the words that you'd hear a lot in relation to IPO processes. And then just a bit about dealing with the ASX and ASIC, some common issues that we see with IPOs based on our experience, and then just a range of costs that you are likely to incur through the process. So jumping into the IPO team, I should say initially that IPOs are collaborative processes. Obviously, management is key. Often it's, and usually the case, that it's their business, it's their efforts that have led to the company being in a position to consider an IPO. And ultimately, as I point out, management bears responsibility for the process and its outcomes, but they manage those risks and that workload by appointing a team of experts around them, obviously of which Tim would be one as an investigating accountant. And we as a member of the legal team, but numerous others as well. So I'll touch on some of the key players there in the next couple of slides and just give you an idea of what their role is in the process. So, of course, first and foremost in any IPO is the board and key management. Depending on the size of your business, the board and your key executive management may well overlap and be the same people, whereas obviously in a larger business, there might be more separation between the board and executive management. But ultimately, the way the rules work is that responsibility for the process and its outcomes and answer, in terms of accountability to investors, it is the directors who bear all that responsibility. However, they are assisted in that process by appointing a team of people around them who guide them through the process. So typically they would rely on advice from us and from Tim, for example. That said, it is their responsibility to ensure that the due diligence process is properly carried out and to approve the prospectus. So in that sense, the law attributes that responsibility to management, but as I said, it is the job of the IPO team to make it possible to put them in a position where they can do that with confidence, so that the outcome is delivered. So I guess one thing also to remember is that aside from legal liability issues, investors ultimately, in my view, invest largely in the management team. So it's management's achievement and responsibility to position the business in such a way that it's ready for listing, that it's attractive to investors. So they are front and center through the whole process. And unfortunately, the way the law works is they do bear personal liability for anything in the prospectus that turns out to be incorrect from a legal perspective. But again, that's just a risk that we manage through a fairly well-established IPO process. If you do have separation between directors and executive management, then obviously the directors tend to form a due diligence committee with members of key management who will support the process in a collaborative way. So I guess the upshot is that the IPO process is collaborative. It's based on a team approach with the board bearing responsibility, but delegating a lot of those responsibilities to people with expertise to efficiently manage those risks. In terms of the legal team, obviously this is our central role as lawyers. And I should say that the legal team typically is in a project management role in any IPO. So we would typically create a project plan and run the entire process. In some ways, I compare it to conducting an orchestra. Each member of the orchestra is an expert in their own right, but we tend to set the program, run the timetables, obviously in consultation with management, and set the paradigm through which all of the advisors deliver their work. Obviously, our job is to put management in a position where it can, to the best extent possible, comply with the law and the disclosure requirements about giving information to investors. So we would typically advise management on setting up a due diligence system, on what the disclosure standards are, what inquiries should be made, and we manage the implementation of that system and create reports so that ultimately, if anyone ever looks at how the transaction was undertaken, there is a comprehensive record on how we got to the end result in the prospectus. I'll touch in a little bit later on exactly what the due diligence process entails. But we typically take the lead in drafting the prospectus in terms of creating a skeleton or framework into which we can plug in the input we receive from key management, from the directors, and from Tim and other experts. You might have seen in the previous slide, in terms of the IPO team, depending on the nature of your industry, there might be several additional experts involved. For example, a geologist would typically be involved in an exploration listing, perhaps a mining engineer if you're actually an operating mine. In technology listings, typically at least a patent attorney, if not other technical experts, if you, for example, are manufacturing a medical device. So what we do is, as I said, we conduct the orchestra and coordinate the work of all of those experts and funnel the results of their work through in a coherent way that puts management in a position to be confident at the end of the process that the prospectus is complete and that they are more than likely to comply with the disclosure standard. I just may mention, or should mention, the fact that often businesses have operations in multiple jurisdictions. We're actually doing one now that has mining projects in both Australia and South Africa, and as a result, we are coordinating the work of foreign lawyers there, which is just part of our project management role to coordinate the work that everyone's doing. And I'll explain in a minute how we actually document and produce all that. One of the key additional players in the IPO team is without a doubt the lead manager. Ultimately, they are responsible for going out and marketing the opportunity to investors, to get the investors in the room. The process typically commences with a discussion between management and the lead manager about pricing, which obviously goes to valuation. There's obviously tension there because your lead manager is likely to want to price the offer with the maximum chance of success, which obviously means a lower valuation. And no doubt the owners of the business, the vendors, are interested in maximizing that. But that process often results in a reasonable outcome where the compromise position is satisfactory and gives the offer the best chance of success. That said, even some of the biggest broking houses in Australia get it wrong, and we had one recently where the valuation that was agreed with management and the broker turned out to be unacceptable to investors. But obviously, being problem solvers, we resolved that and reissued the prospectus with a more acceptable valuation, and this time underwritten, which I'll explain in a minute. And that offer's likely to close in the next couple of days. So just going back to our legal role, I should mention that in many ways we're a sounding board for management and members of the DDC. Our phone will ring constantly during the process, and we get all sorts of questions. How do we do this? How do we disclose this? Should we disclose this? Some cases, I was going to mention that you might get a letter in the mail if your IPO efforts become knowledge through the AFR and other sources. And people who think they've got claims against the company will write you a letter saying you owe them money. Those are the sorts of exigencies that we can deal with during the IPO process. And obviously, we've seen a lot in the last 15 years that I've been involved in doing this work. But back to the lead manager, the marketing of securities, marketing of the offer is the mechanism by which you get in front of investors. Typically involves the broker organising a roadshow, and key management and vendors are a critical part of that. You certainly need to have the aptitude to stand up in front of a room of investors who sometimes we think are looking for excuses not to invest and convince them why they should. That said, by and large, in our experience, by the time we've got our clients to that point, almost invariably they succeed. And we've worked with most of the large broking houses in Australia. Underwriting is an interesting one in the sense that it is technically a guarantee that once you launch your offer, it won't fail for lack of investors. The underwriter, usually being the lead manager, although sometimes you might get joint underwriters also, effectively agrees to take up any stock or shares that have not been taken up by investors under the offer. They assume effectively the risk that they won't market it sufficiently to get investors to take up. And they do this by typically sub-underwriting through their network. So through your one or two underwriters, you effectively get a very large broker network under that ensures success. And in fact, they only typically sign the underwriting agreement, literally sometimes minutes before the prospectus is lodged. And the reason this happens is they usually only sign the underwriting agreement when they're certain that their network is good for it, in the sense that they've got commitments. So it's certainly a optically attractive way of positioning an offer, although of course it obviously involves additional fees to underwriters for that service. But in many cases, it's been very fruitful for our clients. Of course, Tim has already given you a heads up or some insight into the investigating accountant's work. Obviously, it's key. The investigating accountant is typically the corporate arm of your auditor, if you have one. Their job in the process is to help present the financial information in the prospectus and to give investors assurance that that information has been prepared in accordance with appropriate accounting standards. But just taking a step back, in terms of what is the information, the financial information that ought to be reflected in the prospectus, the investigating accountant typically prepares a set of pro forma accounts, which are special purpose accounts produced for the prospectus and which are reviewed. And they, in layman's terms, looking at it from a lawyer perspective, take your last set of accounts, be they 31 December or 30 June, depending on the timing of your prospectus lodgement, and they adjust those accounts for material transactions that have occurred post the balance date, and they adjust them further to account for the funds raised under the offer and the costs incurred, so that they take your last set of accounts, as I mentioned, and effectively make them look like the listing had, or your offer had just closed on the balance date. And that way investors can see your latest set of financials adjusted for the company's new position at close of the offer. Another important role that investigating accountants fulfill is to provide materiality guidance. So you'll see in a sec when I touch on due diligence that we make inquiries about the company's position, almost like a legal audit. But we don't want to be burdened with immaterial things. We often refer to photocopier leases. Obviously, they are a liability, but typically the amount of money at stake, the liability extent there is not large enough generally to warrant further investigation. So the investigating accountant will apply accounting standards to guide management and the DDC about what's financially important within the context of our due diligence inquiries. Now, I should say that's quantitative due diligence in the sense, or quantitative materiality in the sense of how much is something worth. There are other issues in due diligence that don't necessarily have a financial value or are not capable of being attributed a value like that. And they are what we would describe as qualitatively material. So an example is all related party transactions are always deemed to be qualitatively material, and hence dealt with discreetly through the process. Just in terms of pre-IPO structuring of your company, again, Tim has touched on that already. Most of our clients in the IPO journey start out as a proprietary company. So often the first thing we do is either convert that company to public or do what we call a top hat, where a new public company is listed and acquires all the shares of your existing entity in exchange for its own shares, what you call a script for script rollover. That entails some CGT issues that typically the investigating accountant would be across to ensure that your shareholders get rollover relief for that. Also, obviously, there's going to be a vendor sell down and issues of new shares. That's something that is dealt with at this stage as well in terms of putting procedures in place for that. Just on the capital structure, almost invariably we'll see a share split or share consolidation, depending on exactly how the offer is going to be structured and your history of raising capital. And interestingly, recent experience is that just in terms of converting the company to public and getting through shareholder meetings to undertake a share split or consolidation, you sometimes find some of your shareholders see it as an opportunity to extract additional benefits. And it obviously is a contingency we cater for, where we've had, for example, a shareholder refusing to sign a circulating resolution to convert from proprietary to public. And we've had to then go around that with actually calling a meeting. These things happen, but it's just part of the exigencies of the process that we deal with. In terms of board structure, Tim's already touched on this, but you'll see when we talk about suitability that the composition of your board is now a critical issue in terms of being acceptable for listing to ASX. In essence, you need at least one director with significant ASX governance experience, public company governance experience. Certainly, at least one in Australia is, I would say, an absolute requirement. In terms of accounts and audit, I think, again, Tim has touched on this, but just to build out a bit on that, from a practical perspective, a lot of IPO candidates come in with no audited accounts whatsoever. So Tim's colleagues in the auditing team would effectively go back and undertake an audit for either 2 or 3 years, depending on whether the assets or profits test is being utilised. So that can be a delay, but again, it's something that happens quite frequently. Just another issue is tidying up the share register and appointing a share registry. You'll see when we discuss escrow that a clean and logical share register that incrementally records every single share that's been issued sequentially is very important in terms of actually getting an accurate escrow outcome for your shareholders. So yeah, as you can see, there are a few things you need to do internally to get your entity ready for IPO. Just another one is governance. Again, typically, many clients starting out as PTYs don't have formal board governance policies, procedures, and structures in place. As part of our work on the legal side, we give our clients templates and consult with them about how to put those in place and ensure that the board is going to function smoothly within the paradigm of a public company. Just on ASX admission requirements, again, touching on things that Tim has addressed, but one of the keys that we would like to stress in this discussion is suitability. So just quickly moving on to suitability, this is a very, almost want to say, arcane test that the ASX applies. They've got a very wide discretion to refuse listing to an entity whose operations and structure they think in their sole discretion is not appropriate. And this came to the fore in about 2016 when Goodman quite famously got knocked back by the ASX and obviously attracted a lot of publicity. This was the first time that I think the investment community became aware that the ASX would exercise this discretion and actually knock back fairly significant and well-publicized listing. Just yesterday in the AFR, an entity called Mawson Infrastructure announced that it's listing on the NASDAQ, having raised 50 million Australian dollars and having $1 billion market cap. Interestingly, they were declined by the ASX on the basis of suitability because the ASX currently holds the view that their business as a Bitcoin mining operation isn't necessarily something that they consider suitable for listing in Australia. So I thought that was quite unfortunate for us. That certainly the vendors indicated they would have preferred to have listed in Australia. But just again, quickly shooting through some of the the sort of high level key issues. Capital structure is one. So where you have convertible notes, preference shares, or other types of or classes of shares on issue, those are something that could affect suitability because ASX rules provide that your capital structure and rights accorded to various classes of shares must be acceptable for a listed company in their discretion. So our strategy typically is to keep that as vanilla as possible. Shares or fully paid ordinary shares obviously tick. Options, especially for directors and employees, tick, but anything else like convertible notes and other things make things more complicated. That said, we've certainly done listings where convertible notes remained on issue, particularly to directors who had funded the company beforehand and they were converted or repaid, but just adds a layer of complexity. On the legality of operations, that's an interesting one. If you think back a few years to medical cannabis and before that industrial hemp, there were some question marks about, for example, whether an entity operating in Kentucky in the US was federally legal, given their legal system. And the way we had to address that listing was to get opinions from specialist counsel in the US about the legality of their operations, and it had to navigate some legal uncertainty. So they expressed opinions, obviously based on what they considered to be the likely interpretation if they were challenged on that legality. So thinking about Bitcoin miners, for example, at this point, or coin offerings, some of the legality or legal rights attaching to those types of instruments are, I suppose, at this point, slightly vague or unknown, not yet regulated. So it certainly would be more difficult to list one of those in Australia than other more, I suppose, typical businesses. Another interesting one is experience of auditors. The ASX now vets advisors who are members of the IPO team. So if your auditor doesn't have experience at ASX public company level, they might be deemed, unfortunately for them, unacceptable for the purpose of working in relation to the IPO. I mean, typically, obviously, it might be smaller firms, suburban firms that don't have experience at ASX public company level. But other advisors also, it's well known that some more peripheral broking houses have been effectively omitted or not permitted to work on listings at the ASX. So the credibility of all your advisors is important. And just recently, they asked us for the credentials of a bunch of geologists from various countries that were jointly reporting on foreign assets of the client. So certainly, if you get advisors involved in your IPO team, getting their credentials ready to give to the ASX is very wise. Structure of business operations is looked at quite closely. I think the key issue there is just where you've got joint ventures, particularly corporate joint ventures or entities that are not wholly owned in the group. ASX will very closely scrutinise those structures to make sure that, as they put it, there's no opportunity for benefits from operations to be diverted from shareholders of the listed company to other persons who, in a way that's not necessarily proportionate or fair in ASX's view. So the more complex your business structure, both operationally and technically and legally, more carefully we have to think about those things. Our relationships with related parties are a given, obviously always closely scrutinised, particularly loan arrangements. A really difficult one in terms of suitability is the stage of development of your business. ASX guidance is a bit cryptic on this, but yet it's a very significant issue. They say that your business needs to be more than just a concept in order to be suitable for listing. So clearly that means that if you're developing something, you probably need to put in place a lot of the building blocks of that technology, that business before you could consider listing. But that said, not necessarily revenue. I think it depends in many ways on how well known your business model is to the ASX. So they'll list an exploration company that has no prospect whatsoever of earning revenue anytime soon and runs a cash burn model. In terms of pharmaceutical companies, also they're likely to list those even though they're quite far off from revenue, provided their product is at a reasonable stage of going through clinical development. But at the same time, in the cannabis space, there seems to be a reluctance to list cannabis companies now, medical cannabis companies that don't have at least some significant commercial revenue. And how much that is, obviously depends entirely on the individual characteristics of the company. Just one more thing, operations in emerging markets are closely scrutinised just to make sure that I guess the ASX feels that there's legal certainty and financial certainty about how they fit into the listed company's picture. So there are certain jurisdictions that attract more attention than others, but generally speaking, if you have operations in emerging markets, a bit like the South African one I'm looking at now, we have to ensure that we've got advisors around us who can convince ASX about those risks being adequately managed. I need to refer to just one more thing on capital structure. One inquiry that ASX made, or one conclusion they drew that surprised us a bit, was they seem to look at valuation more intensely now, particularly in companies that are listing on the profits test basis. In one instance, they reviewed equity capital investment, which had been very low because it was a very highly leveraged business. And they concluded that in relation to the IPO valuation, the underlying equity investment that the owners had put into the company didn't support that valuation. And on that basis, they raised issues with the listing. So in terms of capital structure, gaining a clear understanding of the valuation rationale for your listing offer structure is actually quite important now, I think. I think now that we've just run through some of those suitability criteria, it might be a good moment just to take a poll on how you feel your business satisfies some of those suitability requirements. So I'll just give you a few seconds to complete that poll. Right, thanks everyone. I think we should have those results in a sec. So looking at the results on screen, you can see certainly a reasonable number of you think that you're across the line there. the vast majority of you seem to be either unsure or think that you've got most of them. I should say that whether or not you currently satisfy those requirements is not necessarily a litmus test of whether or not you should be considering an IPO. A lot of the work we and Tim do in relation to IPOs is ensuring that if you don't get there yet, that you progress to that point as quickly as possible. And when Tim mentioned earlier, 2-year listing process, that's typically where we've got issues like this, where some work needs to be done to get you to that point where you will comply. Just looking at some of the other admissions requirements, Tim has touched on the profits test and assets test, so I won't dwell on that. Escrow, again, Tim has gone quite extensively into that. I just think the one point to note is that voluntary escrow sometimes plays a role, particularly where you're underwritten, the underwriter will ask key shareholders who are not necessarily getting escrow to enter into a voluntary escrow arrangement, so that the shares can be traded for up to 6 months, 12 months, usually 6 months. That just gives other investors confidence that the cornerstones are standing behind the business and the valuation. But the one thing to note there is that voluntary escrow actually impacts your spread. So to the extent that shares are voluntarily escrowed, they are counted as if they were mandatory escrow. So that can impact the number of shareholders counted that actually are counted for spread. Just on the process of escrow, we compile a very detailed breakdown of the share register and go to ASX with submissions. So we've got a fairly clear idea before the ASX makes a ruling on exactly where you're going to land there. Again, on the next requirement with the spread and free float, I think Tim has touched on that quite extensively, so I won't go further into that. Just on prospectus content requirements, as you can see, there's a reference there to section 710 of the Corporations Act. The upshot is, and the way our clients tend to characterize it, is that you need to include material information. Everything that's material to investors should be there. And it's not just what you know, what management knows, it's what you would find out if you made reasonable inquiries. And that reasonable inquiries element is ultimately what gives rise to the due diligence regime. Just, I guess, anecdotally on the prospectus, it is a narrative. It's really telling your story to investors. So we start out with a fairly broad and rough narrative, but gradually refine it as we push it through the regulatory filter of disclosure. We typically avoid adjectives and try to keep things factual, but in many ways, it's still a narrative telling management story, where they started and where they've got to now. So there's quite a lot of creativity in it, and it's certainly one of the parts of the process I enjoy most is actually sitting down and working out how we're going to articulate that story. I find that really enjoyable, and yes, certainly it's probably the part that our clients get most enthusiastically involved in. I should say also that there is a raft of regulatory guidelines and requirements around prospectuses, but obviously it's the task of your legal and accounting and other IPO team members to understand that. If you're in a specific industry like minerals, JORC and Bellman disclosure regimes apply, and various others also for biotech and other specialist industries. But that's just for us, just part of the process. We have a very large checklist that gets us through prospectus disclosure. So due diligence, excuse me, it's something you hear about a lot. I guess in short, we break it out into what the objectives are and how it gets done. In terms of the objectives, it's really quite simple. We want to make sure that the prospectus contains things it needs to contain, both by including material things and not excluding material things. The idea is to make sure that the prospectus can't be described as misleading or deceptive or having omitted anything. And if all that fails, because due diligence is still ultimately a limited process. We are not, we don't profess to be clairvoyant. If things go wrong, the idea is to show that even if the prospectus was defective, inquiries that were made that underpin it were satisfactory and reasonable, such that no liability ought to be visited on those associated with the prospectus. And that's what we call the due diligence defense. So that is one of our objectives. Just in terms of how due diligence is undertaken, the board appoints as I mentioned before, a team of experts around them, and they in turn comprise the Due Diligence Committee, which effectively sets out a procedure and manual for conducting inquiries to make sure that the prospectus ultimately reflects the good and the bad about the business in a way that complies with the law. We create a thing called a Due Diligence Planning Memorandum, which is terms of reference for the Due Diligence Committee. And the committee then delegates specialist responsibilities under that to various members, accountants, lawyers, geologists, patent attorneys. And so we conduct a process of inquiry, Q&As with directors and key management, searches of registers and reviews of documents. And ultimately, our job as lawyers is to document all of those inquiries, document that process, minute the meetings, and create a paper trail of precisely how we got to the end product in the prospectus. The idea is to identify and treat risks such that we can be as sure as any person can be that the prospectus is fulsome and accurate when it's completed. Just on to dealing with the ASX, the key takeaway there is we de-risk the process to some extent, given some of the nuances in suitability. For example, and ASX recommends that we apply for in-principle advice right at the outset on whether ASX sees any problems in our structure. So the application for this advice costs $5.5K from an ASIC fee perspective, and it gives ASX a fairly detailed summary of your history, your strategy, your shareholder base, and exactly what the offer looks like, what you're seeking to achieve with the offer, and how it will affect your capital structure. So that's the key takeaway with ASX. The other takeaway is that we consult with them early, we engage with them, and de-risk the process by trying to identify issues early in the process. Moving on to ASIC, as Tim mentioned, you lodge the prospectus there. They don't generally pre-vet prospectuses, although in certain cases we can ask them questions about matters that might be unusual, and they've been typically quite helpful in resolving those. Once the prospectus is lodged with ASIC, they review it for between 7 and 14 days, and either will say nothing if they're happy. If issues have arisen, they'll engage with us, and we have actually had quite a lot of success in resolving those issues without any need to change the prospectus. But in some cases, we either recommend a short supplementary or a replacement prospectus to address issues that can't be addressed by negotiation. And at one point, 70% of prospectuses in Australia were being replaced. It doesn't impact adversely on your transaction. Just moving on, conscious of time, causes of delay, typically just poor documentation, contracts that are elapsed, invalid, don't exist, things that we have to fix as part of due diligence, disengaged stakeholders, but more importantly, management overstretched, distracted by the requirements of the business. There is an impost of time, unfortunately, and I guess passionate management who is invested in our process makes our job so much easier. Just on costs, obviously they range quite extensively given the variation in sizes of businesses, but a small cap exploration listing or small cap technology listing, it might only cost you 85K from a legal perspective. But obviously, if we're dealing with a much larger, multi-$100 million business, then they might go up to 300,000. But there's very clear sight on fees from the outset about what things are going to cost you, and it ultimately gets reflected in the prospectus as a cost of the offer. Mindful of Tim's timeframe, I did include a best case critical path, but this would only apply for very clean skin, very simple IPOs. Again, referring back to mineral exploration, typically it would take us no more than about 8 weeks to prepare the prospectus, assuming that everything's in order and there's no rectification needed. So this is an absolute best case scenario and would not be anything close to typical. Just thought I'd put that in there for those on that side of the continuum of complexity. And just for information, obviously a chart just for your own use in terms of trying to map the entire process from start to finish. How do you start and then end up with a closed offer under prospectus? I think having had the opportunity to listen to Tim and I just thought it would be useful now to just again take a poll on whether you think an IPO might be appropriate for your business as given where you currently stand. Let's take a couple of seconds while we give you a chance to respond. Thanks, everyone. I'll let you know as soon as we get those results. I think at this point, I'll hand over. Well, there we go. A large number of you are undecided, which is understandable. You know, there are, as demonstrated by the seminar series, a number of options for exit and liquidity events available. But again, in terms of valuation upside and other long-term benefits, certainly an IPO should be in the mix. And a smaller number of you said no. So again, perfectly understandable. But it's good to be clear-eyed about your options at exit. I'd like to thank you all for listening to me and give you an opportunity now to address some questions to us.
Fantastic. Thank you for that, Brent. We have received a couple of questions for my guests today, and I'll post some of them to their presenters now. Tim, I might direct the first question to yourself if you don't mind. Is there a revenue requirement to list on the ASX under the assets test?
No, there's not. And Brent actually touched on this very issue when he sort of went through his presentation probably not longer than 10 minutes ago. So there's no prerequisite around revenue under the assets test. But similar to what Brent said, really what the ASX want to see line of sight on is the route to commercialisation, in particular for certain sectors. So not so much exploration, because that's a fairly well-trodden path and sector in Australia, but certainly technology. We've seen issues in life science as well as medicinal cannabis, where the ASX has taken a fairly pervasive view where they couldn't see the business model creating a point of commercialisation.
Fantastic. Thank you for that. We've had another one come through, and Brent, this one might be best suited for yourself. Why would multinationals choose Australia for listing purposes?
Yeah, obviously a very good question. I think there are a number of typical advantages cited. I think one is on a relative scale, the ASX requirements for admission are quite lenient compared to other major exchanges around the world. As the threshold requirements are a lot easier to satisfy. Certainly also the ASX is known to be strong in particular sectors. Mining resources, oil and gas are very strong sectors in the ASX, and investors might believe that the investment pool in Australia is more supportive than, for example, if they're operating out of Singapore, where the board has a very different composition. And I think also in terms of regulatory transparency and rule of law, Australia certainly represents one of the top-notch destinations from that perspective. So I think an ASX listing gives a very high level of credibility to a business with international operations.
Excellent. Did you have anything else to add to that, Tim?
Yeah, no, I did. Thanks, Glenn. I mean, I've done it in conjunction with Brent. We've worked together on a number of overseas IPOs, and typically a couple of reasons why a company may choose Australia as a destination to list is largely tax driven. If there's large investors who are Australian residents, an ASX listing gives them the best tax outcome. And secondly, if Australia is that market they wish to explore in terms of that commercialisation strategy, typically they want to list in that market where that's going to occur.
Fantastic. I think we do have a couple of other questions come through, but just in the interest of time, we might need to wrap it up there as we're conscious a few people need to go. We thank everyone again for joining us today and trust that you found the information beneficial. When you do exit the webinar, you will receive a short feedback survey pop up on your screen. We really appreciate you taking a moment to provide us your response so we can continue to improve our webinars. If you do have any questions, we did provide the contact details for our presenters, and as also mentioned previously, we will provide access to all of the slides and the recordings at the conclusion of this session. If not today, it will definitely be by the end of the week. And if you do have any questions that you want to go back to directly to those presenters, please feel free to reach out and they will be able to respond and provide you a more personal response. On that note, we'll wrap it up today. Thank you again for joining us, and we hope you enjoy the rest of your day.
Thanks.
Thank you, everyone. Thanks, Brent.
Thanks.
See you later. Thanks, Glenna.